Okay, so let's go ahead and get started. I'm going to make my slides full screen in just a second. So just bear with me while I'm toggling between these two different screens. And I may move between that and some charts, so if anything looks odd, please just let me know. Okay, well, I want to thank you everyone for joining me today. My name is Lien, and I am Managing Partner of BKForex Advisors and Director of Currency Research for GFT. Today what we're going to talk about is FX strategies for volatile markets. Before I begin, I'm just going to show you this disclaimer for a second, which basically says that, trading currencies can be risky, so you can make money, you can lose money, so it's important to know how much you've got risk in the market at any point in time because it is a speculative market, and because of that, it can be risky. So, to begin, what I want to talk about is how volatility in the market has really increased significantly over the past few months, maybe even, years in that case. And the increase in volatility has shaken up or shaken out a lot of traders. So people are wondering, what can I do about it? Well, the old ways of trading don't always work these days. And what I mean by that is that typically when you're learning about trading for the very first time, you're taught to buy low, sell high, buy low, sell high. But the problem with a market where we have a tremendous amount of volatility is that if you try to adhere to the buy low, sell high mentality, you may end up getting stopped out a lot because of the wild swings in the market. At the same time, another common practice or old way of trading or investing that people use is to try to adhere to a 2-to-1 risk-reward ratio. Now, that may be suitable in many markets, but the problem with trying to do that in extremely volatile markets is that if you're risking a lot and you're trying to make 2 times that risk, it may be difficult to achieve because when we have volatility, that basically means that we have wild swings. So when we have wild swings, that makes it very difficult for people to be able to always hit their profit targets. I mean, for example, let's say you are looking to risk 50 pips and you want to make 100 pips on an intraday basis. Because of the volatility in the market, you may see the currency pair rally 75 pips and then completely reverse and go to break even and then possibly even end up stopping you out. So that's kind of the danger because volatility means that we have the roller coaster like price action in the markets that make it difficult to follow the old ways of trading. Number 3, one of the things that we're taught when we're trading or investing is that we should avoid getting in and out of the market too often because, the trends of the market kind of large and, they're kind of consistent and so forth, which may be true if we're looking on a day-to-day basis chart, like a daily chart. But if you're trading intraday, that may not be so true because of the volatility that you get on an intraday basis. And so you might need to be very quick and nimble with your position. So the whole idea here is that the old ways of trading don't always work. So going forward, what can you do about it? Well, what you can do is you can try to turn this volatility into opportunities. In order to do so, let's take a look at, what has caused the volatility over the past couple of months. Now, this is just to give you a sense of the causes of volatility over the past year and a half. These are the different things and the major events that have occurred around the world in the past year and a half. And this includes, starting from the bottom up, 2010 earthquake in Haiti where hundreds of thousands of people were affected. The heat wave in Russia that caused commodity prices to move up and, a bunch of casualties as well. If you have followed the headlines, you may know how messy the BP oil spill was in 2010 and how long it took for that situation to be cleaned up. We also have the flash crash of 2010. I mean, 2010 seems so long ago to many of us, but That was also the time when we had that 1,000 points move in the Dow intraday and the near immediate reversal shortly thereafter. The European sovereign debt crisis, still something that most of us are grappling with, or the market is grappling with this day. I mean, if anything, last week's price action shows that the sovereign debt crisis is alive and kicking, and one of the big reasons why the euro-dollar basically plunged from 147 down to 143 over the course of just a couple of days. Floods and cyclones in Australia in the beginning of the year caused quite a bit of unrest or disruption in supply activity for the country. The unrest in the Middle East, all the conflicts and protests and things like that. We had two major earthquakes in New Zealand, one at the end of last year, one at the beginning of this year. Last night we had two, fairly sizable aftershocks. One that I think was around 5.0, one that's around 6.4 in magnitude, and that caused the one remaining high-rise in Christchurch to topple. And then we had the earthquake in Japan. This should actually read March 2011. But anyhow, the earthquake in Japan and the accompanying nuclear crisis, something that Japan is still grappling with. We have the BOJ rate announcement later this afternoon, and there's a very good chance that they could alter monetary policy or make suggestions based upon how the economy is behaving since the earthquake. And then we also had joint intervention in the Japanese yen this year, the first time in more than a decade because of the earthquake. The point that I want to make with all these examples is that the black swans in the world, which are events that are not supposed to, that are rare, that don't happen very often, and we don't get to see them very often, are becoming much more frequent, and having a larger impact on the financial markets. And the magnitude of these black swan events are becoming much stronger as well. And so these volatility creating events are still here with us, to some degree, such as the European sovereign debt crisis is still here with us. Japan's still dealing with the earthquake. New Zealand's still dealing with aftershocks. So these things are alive and kicking, and there's a good chance, unfortunately, that they could continue to unfold and manifest in the markets and be something that we struggle with for the rest of this year. So with that, it's very, very important to understand, to learn how volatility affects us and how you should adjust your trading in order to deal with that. And also, I've got some suggestions on different FX strategies to implement in order in this type of high volatility environment. And just to show you some quick charts to show you the kind of magnitude of volatility. If I just pull up my trading station, and I'll refresh my screen so you can see that. Just give me 1 second while I click on charting package. Okay, so this is the charting package. Let me just renew my camera. Okay, so right now you should see a chart of the New Zealand dollar to show you the volatility and the movements. In 2011, we had a very significant movement across the financial markets. More than 1,000 pip rally in the New Zealand dollar between February and May. On top of that, we also had, some intraday swings with the earthquake and with some big events in New Zealand. I wouldn't preclude, on a continuation of this sell-off and a more, deeper volatility. Taking a look at the euro dollar, just to show you, once again, you see a tremendous amount of wild swings. Between November and January, we had more than 1,000 pip sell-off in the euro dollar, followed by, about a 2,000 pip rally between December and April, and then, about 1,000 or 800 pip sell-off between April and May, and just, more and more volatility. And this is all caused by the sovereign debt crisis. Take a look at the stock market. Let's just take a look at the U.S. stock market real quick and show you the kind of volatility we also have over there. This is the S&P 500. And you can see, once again, very deep sell-off in the Dow Jones, or sorry, the S&P 500. Basically, the S&P 500 fell from about, 100 points from its May peak. And this is going to remain with us. So it's important to understand how volatility affects you and what you can do about it. So let me just refresh my camera again so you can see my slide. So how does the volatility affect you? Well, it affects you in a couple different ways. Number one, you can have very fast, unexplained movements in the market because you can have some breaking news on Greece, and that can cause tremendous amount of volatility in the euro dollar. For example, if you were watching the New Zealand dollar charts last night, what you would have seen is that pretty much around the Asia Open, we had the New Zealand dollar plunge more than 100 pips in a matter of, I think it was just a matter of about an hour, simply because of the aftershocks that were happening in New Zealand. You also have overnight volatility. So what this overnight volatility means is that it'll be really, really important to use stops for overnight positions, or at bare minimum, reconsider whether or not you want to hold the positions overnight because of the breaking news that can happen while you're sleeping. You can also have exaggerated trends. That's kind of what we're seeing in the euro dollar, where because of the sentiment, first with the build-up into the ECB rate decision and anticipating that the ECB was going to be slightly more hawkish, to how bad can this Greece scenario get? And so you get these exaggerated, very deep movements in the currency market. I mean, that's basically what we saw in May and what caused the euro dollar to fall from a high of 149.40 all the way down to a low of below 140, which is because of the fear of the sovereign debt crisis. So these trends can be very exaggerated in magnitude. So just because it's falling and it's going from 149.40 down to 145, you think to yourself, 145 is a nice round number, it should be support. That may not necessarily be the case if you're in a scenario where this is being caused by, extremely negative sentiments, things that are creating negative sentiment, and that can lead to exaggerated trends. And also you can, volatility can lead to positions or, movements that are very correlated. So, for example, there's a good reason why euro dollar, euro pound, and euro Swiss are, seeing such weakness over the past few trading days, because it's all driven by euro dollar weakness. So that's really what you're looking at, because this euro dollar weakness is really weighing in the markets and causing all of the euro crosses to fall significantly. So what can you do about it? That's the, $600 million question. What can you do about increased volatility? Well, there's a couple things that you can do about it, and we'll go back and answer questions, after the session, because I only got one screen up for this. But anyhow, what can you do about it? Number one, the first thing you can do is stay with the trend. The first thing you can do is stay with the trend. Now, if you ever followed any of the works that I have, I love to use what I call Bollinger Bands, a double Bollinger Band. So one way to basically get your hands around the volatility is to be able to understand what the market is doing right now, what's the trends in the market, and then position yourself on the side of the trend. So let me give you an example. Let's pull up what the euro dollar is looking like right now. So I'm going to pull up my chart. I'm going to add my okay, so right now you should see my chart. I'm going to add my Bollinger Bands onto here so I can give you a good sense of what we're talking about. I'm just going to change all of those to the same color just for my own personal reference. Okay, so that's our outer Bollinger Bands. Actually, I have one that's different color, but we'll just ignore that for now. Change this to 1 standard deviation. Get rid of the middle line. I'm going to change this to black. Change the lower line to black. Okay, so let's pull up the euro-dollar chart. So this is a chart of the euro-dollar. So I talked about how you want to stay on the side of the trend. So the way I use the Bollinger Bands, just to refresh for those of you that are unfamiliar with it, as a rule of thumb, I like to say that when the currency pair is trading the 1-2 band the upside, I say that it's in the uptrend. When it's trading the 1-2 band downside, I say it's in a downtrend. Now, when it comes out of the Bollinger Bands, frequently what you'll see is like to touch the Bollinger Band on the other side. So when I say you want to stay with the trend, is that, if the euro-dollar had previously remained in the 1-2 band the upside, one of the ways to harness the volatility is to understand that the uptrend is still very strong and just to ride the move. Because if you were in this case here, for example, just a couple of weeks ago, that the sell-off was kind of persistent if you want to kind of go in the direction of the trend. Now, when the uptrend reverses, which is what we're seeing right now in the euro-dollar, you also want to go with that trend because there's usually a very good chance that it could extend to at least the first standard deviation Bollinger Band on the other side, which in this case is around the 140, 150 level. So, the sentiment has certainly turned negative euros, and in this case, there's a good chance we could move down to 140, 125. Another example where the trend is slightly more dominant is in the Kiwi dollar. I'll just pull this up in 1 second. So we've got the Kiwi dollar chart that I'm loading up right now. So with the Kiwi dollar chart, you can see, when the trend was very strong, like we have this period here, from the middle of March all the way to the middle, end of April, that the right trade was to stay with the trend. So even though there may be intraday volatility, on a day-to-day basis, sometimes you do get a pretty consistent trend. And I wouldn't necessarily, pick a top or bottom in the currency pair until it shows that weakness. And unfortunately, that's what we have in the New Zealand dollar right now. It moved into the uptrend zone and had been trading there and hit a record high in the process. Right now, it turns outside of the uptrend and into the range trading zone. So at this point, the sentiment in the markets turned bearish New Zealand dollars. And so I would go with this new trend, or in this new turn, targeting the Bollinger Band the other side, which is around 79.55, 79.60 at this point. So that kind of gives you an example. If we just pull up the across, you also see that that's very much the case in across that has a very strong trend, such as Euro Swiss. So pulling up Euro Swiss right now, Euro Swiss, when the downtrend is very strong, you see that the currency pair just kind of falls, and the right trade to take was to stay with the trend. And even though Euro Swiss is at a record low right now, given that the trend remains very weak, if I was trading Euro Swiss, I would also be looking to stay with the trend and to look for further losses in Euro Swiss. So with regards to the first way of harnessing volatility, what you could do is to look for ways to identify the trend and stay with it. The next thing you can do is to trade ultra short term. Now, what do I mean by trading ultra short term? Well, there are 3 ways that you can trade ultra short term, and I'll kind of type into the hot com box so that you can see this. Number 1 would be let's do this. Trade short term. Number 1 would be event-driven trading. Number 2 would be price-driven trading. And number 3 would be time-driven trading. And what I mean by event-driven trading would be to trade breaking news and other such developments. One good example of that would have been, if you were kind of awake for this, it would have been the earthquake or the aftershocks in Japan that we saw, basically the aftershocks in Japan that we saw last week. So let me give you an example of event-driven trading. Let us do dollar, let's see, let me just look at my calendar. Let us do Aussie dollar. We had the recent employment report, and I'll show you exactly what I mean by event-driven trading. The Australian employment numbers were released on June 8th at 21:30 Eastern Standard Time. So let's go to an intraday chart. So what we're looking for is to trade ultra short term. Let's go find June 8th. See if we can get the 9th. All right, perfect. So this was the day when we had the Australian unemployment report come out. So one of the FX strategies that you can implement in highly volatile environments is to focus on ultra short-term trading. So when news releases come out, they usually are, especially when there's a big surprise, they usually can have quite a bit of follow-through in the market. Sometimes it's big follow-through, sometimes it's smaller follow-through. On this given day, when the Australian employment numbers released, if you have been looking at any, calendar that's out there that has economic data, you would have known that the employment report was very, very weak. Only about 7,800 people got new jobs that month, in the month of May, compared to a forecast of 25,000. And you didn't need to, look at the calendar because you can see from the price action in the chart that when the data came out, this candle was the data candle. And so obviously it must have been a weak number because the Australian dollar fell from about 106.55 all the way down to a low of 105.85 in the first 5 minutes of the release. Now, one of the ways that you can do one of the things that you can do with news trading is you could do what we call reactive trading, meaning that after the news comes out, you go in the direction of the news, hoping for a little bit more of a continuation. And the guidelines for that is, number one, you have to wait for the 5-minute candle to close to make sure that the number in this case is indeed weak and the market cares about it and the candle closes red because there's no kind of miscellaneous data to suggest that that it should be stronger or some kind of clues that you may have been missing out in the initial report. So anyway, you see that the Australian dollar 5-minute candle closed this week. What you would do is you would then short the Australian dollar, going for a little bit of continuation. Now, the problem with reactive trading is that sometimes a large part of the move has already occurred. But usually this move is occurring because it's a very significant piece of data, and so there should be continuation. So you would go short with about 25 pip stop, or 20 to 25 pip stop, 20 to 25 pip target. So in this case, in the Australian dollar, we would have shorted around 105.90. And you can see that the low here is about 105.62. So if we had about a 20 pip stop and a 20 pip target, that target would have been hit. So with the reactive trading, you have to be really fast and nimble. But this is an example of a strategy that you can use in highly volatile environments, which is to trade ultra short term. So that's event-driven trading. The next thing would be price-driven trading. Now, what is price-driven trading? Price-driven trading is basically focusing on price levels in the market. So one of the strategies that that Boris likes a lot, and if you sign up for our weekly newsletter at BKForex.com, Boris talks about this in his scalping videos and his scalping letters every single week, which is what we call the running for the OOs. And we actually had that example today in the euro dollar. If you're not familiar with this, sign up for a newsletter. We talk about it all the time. It's a free weekly newsletter. So let me just get rid of these. I'll just leave the Bollinger Bands for now. We may need them later. So what running for the OOs means is that you want to wait for currency pair to trade around 50, and there's many derivations of running for the OOs, but the simplest one that I'll talk about is you want a currency pair to come from 50, and you want it to rally, and to go from 50, 60, 70. You want to go long at 80. So if you go long at 80 with a 20 pip stop targeting the OO. So in this case, this is just a movement we saw earlier this morning. So this is at 50, 50, 60, 70, 80. When the euro dollar goes to 80, you want to put a limit order to buy at 80. Stop 20 pips below at 60. So it got nowhere. It retraced a little bit, but it didn't come anywhere near the stop, targeting the OO, which the euro dollar made in this case. And you saw that, pretty nice, a nice trade on this front in terms of targeting the OO. And we probably had this in the Kiwi dollar too, simply because we had such a big news release last night, but I don't know if there's an opportunity to actually trade it. But yeah, there probably wasn't much of an opportunity to trade it during the Asia hour. So that's an example of a price-driven trade. And then finally, the time-driven trading. Time-driven trading is, time-driven trading is something that, is more of an art than a science. But what we like to do with time-driven trading is something we call the session breakout strategy. And for those of you that may or may not be familiar with our session breakout strategy, one way to do time-driven trading would be, let's pull up the pound dollar so I can describe this to you. So this is a pound dollar chart. So an example of a session breakout strategy is basically, we identify the session. And so in this case, the session that we're going to identify is the Asia to European Open. So let me get rid of these Bollinger Bands. And this is a pound dollar 5-minute chart. So you define the session, and it's the Asia to European Open, and I'll show you the vertical lines. So this is the Asia session, and let's get another vertical line for right before the U.S. Open. Actually, it's more like over here is the Asia session, 5-minute chart. So this is so right here is right before the European Open. So this is kind of the range that we're looking at. Let me get one more horizontal line up here. Alright, so we're looking for session breakout. This is called the session breakout strategy. This is the Asia to European Open. Just imagine that it says, alright, so this is the Asian European Open. And these are the ranges that we're looking at. So, this is the high of the range, this is the low of the range. And you can see that the range itself is only about 20 pips in width, so it's a relatively tight range. So it's very simple, in terms of a time-driven strategy. You want to place an order to go long at the high of the session, which in this case would be, 162, probably give about 10 pips leeway, 52, with the stop, at the session below the low of this range, which is at 162.22, so I would probably put it at 162.15. And your first target, you can sell at 2 times risk, or you can have half of your position off at 1 times risk and trail your stop in the remainder of the position. So this is an example of time-driven trading. There's a lot of different ways that you can do time-driven trading. So what I want to illustrate here is that the first way we talked about in terms of the strategy that you can implement to manage in volatile market environments is to stay with the trend. Another way is to trade ultra short term. And the examples of trading ultra short term was event-driven trading, which is trading news, price-driven trading, which is the OO strategy, and time-driven trading, which is trading session breakouts. And those are just kind of 3, simple ways of doing so. Now, the third way that you can, the third type of thing that you can do in order to manage volatility is to avoid range trading and to trade more breakouts. And so we saw that with the session breakout. You can also, if you pull up any charts today, so you pulled up the euro dollar chart, for example, you'll see quite a bit of intraday breakouts in the euro dollar as well. So that's another way to get your hands around the volatility, which is to avoid range trading, because let me just show the euro dollar intraday chart, where range trading really isn't working so well because we've got a lot of volatility on an intraday basis. So just to show you the intraday euro-dollar chart. So look at these wild swings on an intraday basis. So it's much better to look for opportunities to trade little breakouts. I mean, for example, right over here you got a little bit of a consolidation. I'm actually not going to draw the triangle, but you've got a little bit of consolidation. You could trade that breakout over there as well. So I would look for more opportunities to trade breakouts that ranges during times like these where we have more volatile. This is just kind of refreshing the chart here. Just showing you, I was just kind of highlighting this area in the euro dollar, showing how you want to focus more on breakouts because there's a little bit of consolidation with a nice little break higher. So you want to trade more breakouts than trying to pick tops and bottoms during highly volatile market environments. So number 4, diversify. Understand when your positions are correlated. And that's kind of what we have today. This is an older chart, but aside from the New Zealand dollar, which is being affected today by rather unique factors, namely the aftershocks overnight, typically you get an environment such as this, where so the dollar is down against all of the major currencies, and in that case, you have to be really aware of having highly correlated positions because it's quite a danger in highly volatile markets because if you're long the euro and long the pound at the same time, there's a very good chance that they're both either performing well or performing poorly. And this is just kind of another example of, highly correlated days where sometimes you don't even see the correlation just against the US dollar. Sometimes you'll have the correlation against the Japanese yen as well, where the yen will be down against everything. And we saw that quite a bit last week when we had, strong bouts of risk aversion. Now this just kind of illustrates, on an hourly basis, how the instruments, in this case the Aussie dollar and the euro dollar, can be closely correlated. And how you be extremely vigilant with with your positions because you see here the wild swings are happening simultaneously. And so in those cases, you might want to hold more than one position. You might want to look at something, 2 pairs that are not very correlated, such as the euro dollar and the Aussie Kiwi on an intraday basis. So that's what point number 4 was to diversify and understand when your positions are correlated and, being able to apply that properly in highly volatile markets. And then finally, number 5, manage your stops and limits better. So what I'm talking about in terms of managing your stops and limits better is that you have a couple of options. In highly volatile markets, you can either widen your stops to accommodate for increased volatility and take smaller positions as a result, so you have less exposed to the markets. Or you can trade shorter term and have narrower stops and focus on getting in and out and taking advantage of the small bursts in volatility that you'll see on an intraday basis. So that's kind of what you can do in terms of managing your stops and limits better during highly volatile market environments. So we talked about a lot today. We talked about number 1, staying with the trend. I gave you an example of doing that using the Bollinger Bands and having that help you determine where and what the trend in the market right now is. Number 2, trading ultra short term. We talked about price-driven trading, event risk trading, and time-driven trading. Number 3, avoid range trading and trade breakouts because that's kind of what you get more of during highly volatile environments. Number 4, it's important to diversify because if there's one thing that we all should have learned from the global financial crisis is that diversification is really important. We can't have all of our eggs in one basket. And this is particularly true in the currency market because you can easily have all your eggs in one basket and not even realize it. And number 5, manage your stops and limits better. In highly volatile environments, you can either widen your stops, take smaller positions, or trade ultra short term with your regular size positions and use tighter stops. So with that, I want to kind of open up the floor with questions and see if you guys have any questions about what we talked about today. Okay, so the Bollinger Band settings are 20, because some people are asking about that, are 20 period, 2 standard deviation, and 20 period, 1 standard deviation. Well, in terms of real-time correlation source, there's a lot of different places that do that. I know that, I kind of have my own spreadsheet that follows that, but there's a lot of forex websites. I think native.net offers it for free as well. So I mentioned the OO earlier. What does that stand for? That is a strategy that Boris talks about every single week. It's a free newsletter that you can sign up for. He releases videos on it, talking about it. We've got a lot of FAQs on it, and basically it's called Running for the OOs, or Running for the Round Numbers. If you want to sign up for our newsletter and start to learn about that, you can go to this website here, and then on the upper right there's a little tab saying Newsletter Sign Up. I believe the website is native.net that offers real-time correlation. Any other questions about what we talked about today? I'm so sorry about the computer freezing, but I'm glad we were able to get back online. And I believe the session is recorded, so you can feel free to listen to it again as we go through some of the strategies. Otherwise, I hope you got some good content out of here and learned about how you should approach the markets during highly volatile times, because volatility will probably be with us for some time. All right, thank you so much and have a great day.